Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to talk about today's emergency rate cut done by the Federal Reserve. This is an enormous piece of news because this is typically unprecedented territory unless things are going pretty wrong with the economy. So I don't want to turn this into a news channel, but I do need to present you this video and this information. Otherwise, I feel like I'd be doing you an injustice as my audience or as my viewers. So we're going to talk about the facts of the situation. We're going to talk about why they did it. We're going to talk about what this means, and I'm going to give my thoughts at the end of the video. So stay tuned, everybody. It's going to be a good one. Okay, so before we jump into the facts of the matter, I do not want to turn Whiteboard Finance into a news channel. However, this is super important and you need to understand the facts first before I go into the rest of the video. So very quickly, I'm just going to fly through these stats. This is pretty much the most relevant information. Basically, the Fed cut rates today in an emergency fashion. So they don't typically do emergency rate cuts unless it's something crazy like the 2001 dot-com bubble, 2008 financial crisis. The last time they did one of these emergency rate cuts was in fact in 2008. So what they did today is that they cut the federal funds rate by 50 basis points, bringing it basically from 1.50 to 1.75 to 1% to 1.25% guidance. So number two is that the Dow actually reacted positively to this at first. Of course, why wouldn't it? It's low rates. However, overall, the Dow was down 3% for the day, or 2.95% for the day, going down 796 points. That's a pretty big swing, you guys. Number three is that the 10-year Treasury yield actually responded to this negatively as well, and it actually hit its all-time historic low, coming in at 99 basis points or 0.99%. Okay, that's very important. Remember this moving forward, especially when you're looking at mortgage rates for the rest of the year. Mortgage rates typically follow the 10-year Treasury yield. So, number four, another cut is expected to happen on March 18th when the Fed actually does have another scheduled meeting. So we're going to see what this actually leads into. So with those ground facts in place, let's move on to the why. So why did the Fed find it necessary to make an emergency 50 basis point rate cut at this time, especially when they have a scheduled meeting later this month on March 17th and 18th? Well, again, as mentioned in the previous slide, it's typically during times when the economy is not doing well. So as we all know, what's going on right now is the COVID-19 virus, aka the Mexican beer virus. I'm not going to say the name because this video will get demonetized. So we all know what virus we're talking about here. So what this virus has caused in the global market is essentially a broken supply chain, lower productivity because the workers are literally not in the factories in China where most of these goods come from. There's lower levels of consumer confidence where people just aren't spending the money and they're not traveling, they're not doing tourist activities, they're not using hotels, cruise lines, things like that. So it's basically hurting the entire market as a whole. And then finally, Trump is calling for lower rates. This is because he's been touting that, hey, this is the Trump stock market, this is my stock market, economy is booming, which it has, it's been great so far. However, his reputation is pretty much tied to the market. So when rates are low, that means that money is cheap, meaning that asset prices will go higher. That's why real estate prices are at all-time highs. That's why asset or equity prices are at all-time highs. You look at the low rates and you follow the market, and one is connected to one another. Take a look at this tweet from Trump earlier today. So that just goes to tell you that he is all in, and he pretty much has, figuratively speaking, a gun to Jerome Powell, who's the chairman of the Federal Reserve. He's got a gun to his head saying, hey, these rates better stay low, if not lower, that way I can win the 2020 election. And I'm just reporting the facts. If you like Trump, don't like Trump, whatever. I'm just saying, don't downvote the video just because the word Trump is used in the video, okay? So let's move on to what it means. So what does this all mean? So this was actually done to put the market and investors at ease, but really it completely backfired on Jerome Powell and the rest of the Fed. This actually put the market into a panic, as you can see the huge sell-off today of the Dow losing roughly 800 points, okay? Now, the second thing is that this was meant to solve a demand problem. However, we do not have a demand problem, we have a supply problem. So to elaborate on that, monetary and fiscal stimulus is typically used when you want to mitigate demand problems when people aren't spending money, aka there's low demand. So say for example, Mr. and Mrs. Johnson, they got a bunch of money in the bank, interest rates are high, they're happy earning their 5-6% on their money, they're chilling, they're not really spending much money. That's not the issue that we're dealing with here today. Because of that virus that we mentioned in the earlier slide, we have a supply problem where goods and services are not being transferred. So we do not have goods coming over, meaning that they're trying to stimulate something that isn't really stimulatable. I just made up that word. Is that a word? Cut? Never mind. So basically, again, this is not a demand problem like we've seen in the past in the 2001 tech bubble or the 2008 financial crisis. This is a supply problem. And then finally, number 3 is the low volatility of the markets that we've seen over the past couple of years is now gone. If you look at the charts over the past couple of weeks, if you want to look at a specific stock like Tesla, for example, go look at their chart over the past 2-3 weeks. It looks like a Six Flags or a Cedar Point roller coaster, okay? Shout out to Cedar Point, best amusement park in the country. What up? So anyway, the low volatility days are gone. If you look at a chart over the past, let's call it 4 or 5 years of the S&P 500, you'll see creeping up, creeping up, creeping up, little bit of a dip. Creeping up, creeping up, creeping up, little bit of a dip. That's not necessarily the case anymore. I think we're getting into high volatility times here. So finally, let's move into my thoughts and my opinions on the situation going on right now. So to wrap everything up, these are my personal thoughts on what this environment or interest rate environment or this interest rate cut is going to lead to, okay? So rates dictate everything. So if you remember my previous video called Savers or Losers, picture interest rates as a big lever. Interest rates are high, people spend less money, they keep in their bank, risk-free, interest rate, and they're living fat, high on the hog, right? Interest rates are low, savers are losers, you're incentivized to take on debt and invest and stimulate and bring money into the economy by taking out debt and investing, okay? That's kind of the two polar opposites. So interest rates dictate everything. It's borrowing power, it's the cost of money, it's all those things that I just mentioned. Number 2, we're looking at potentially going back to a ZIRP, a zero interest rate policy, where interest rates were flat or low, basically from 2008 to about 2014-15, to potentially a NIRP, a negative interest rate policy. This is where people will literally be getting paid to take out a mortgage or a loan, okay? So look at some countries in Europe. They had mortgages where the bank is literally paying you every month to take out a mortgage to stimulate that economy. So we may be headed towards a NIRP, okay? And if you don't think we are, please let me know in the comments below why you don't think so. Number 3, asset prices will remain high. So equities all-time high, real estate all-time high, car loans all-time high, et cetera, et cetera, et cetera. A lot of stuff is going to an all-time high because we've had such low interest rates for about 10, 12 years now. So what I think is, based consumer confidence aside and investor confidence aside, I'm not talking about the big sell-off that happened today. I'm talking about real estate, for example. So everyone wants to buy a home. It's the American dream, right? When interest rates are super, super low, that means asset prices are going to be high because you're allowed or you're able to spend more money on the purchase price because you can quote unquote fit that monthly payment, the mortgage payment, into your budget. Now, if if interest rates are high, that typically drives asset prices down. So I really do think that asset prices such as real estate will remain high for the foreseeable future. However, real estate does lag the stock market, so I may be wrong on that. Number 4, delaying the natural cycle of the economy. So with this basically Fed manipulation of cutting rates and keeping money super cheap, you're delaying the natural cycle of the economy, and you're potentially flirting with inflation and hyperinflation, but that's a different topic for a different video. Think of like the economy like the water cycle. You know, it rains, goes into the rivers and streams, that evaporates, goes back up into clouds, it rains, goes back up, etc., etc. You look at natural cycles in both nature and in the economy. The Fed right now with these rate cuts is delaying the natural cycle that the economy has to go through to be able to clear out some of the dead wood in the forest. So if you want to look at like a forest fire as an example, yeah, forest fires suck, it destroys a lot of trees, but then you enrich the soil with nutrients and new trees grow, etc., etc. Some of these zombie companies that are living off these low interest rates need to go out of business. It's just the natural business cycle, and the Fed is preventing us from doing that. So I hope this was helpful, you guys. I know this is a little bit of a news/opinion piece. However, this is just to get you thinking about what these rate cuts really mean and how they affect the economy and your bottom line. So if you got value out of this video, please give the video a thumbs up. Please share it with one friend, share it on social media, share it with your neighbor, share it with your dog, whatever. Just get the word out. This channel is awesome, in my humble opinion. You may not think so, but hit the like button anyway. Longest outro ever. Thank you, everybody. Have a good day. Oh, wait. Is it prosperous day or good day? Have a prosperous day.